We are live. Welcome to another episode of Money Matters. My name is Nev, and I am beyond excited that you are here where we're broadcasting live only on onedealaway.com/live. And today we have an incredibly amazing, juicy episode talking about could the market potentially be crashing yet again? Now, before you think I am just putting in a hype, I do have articles that could potentially back up my claim because there's something new that is happening with the Fed, with the central banks. They're shifting of how they're doing stuff and they're shifting what they are doing. They go out, they say one thing, but they do a different thing. And I always keep saying, yeah, I'm going to hear what you have to say, but I'm going to watch what you're doing because by watching what you're doing, I am able to learn way more and be able to protect myself and position myself correctly with those that have an ability to make changes in policies and in what's happening with our money and, of course, potentially with the markets. Because we know as they print, everybody feels safe, so they go on a buying spree. But when they stop printing, what happens then? Can it sustain? And that is exactly what we're going to talk about today. Now, first off, we're going to start off with what I owe you from yesterday, and that is how do you eliminate debt? And then we're going to jump into the markets and find out how can we make money? Because both are equally important. I don't know that one is more important than another because you got to have both. You got to be able to pay on both sides of the team, right? The defense and the offense. And that is exactly what we're going to talk about today. So let's do this. And good morning. Hopefully, you're doing excellent on this Wednesday morning. It is June 24th. Can you believe it? June is almost over. I mean, half a year is almost done. And most of us spent it, well, at home. So, stuck inside. But that's okay. That's okay. This is a different year, and I've said it back in February. I wasn't smart enough in January, but in February I said, this year you might as well just write it off from the get-go and let's get started again. So, all right, let's go and talk about what's going on in the market. So let's go in and take a look at Dow Jones. Slightly up, but mostly sideways, not much happening. Nasdaq actually went up. We did see a little bit of a hump where it started to close down. So we'll see what happens today. Again, S&P, same hump kind of thing happening. Yes, it's slightly up, but mostly flat. Let's take a look at the cryptocurrencies. And in crypto world, we see that the top 10 are basically, sort of up, sort of down, mostly staying flat. Not much happening there. If we go in and take a look at the biggest gainers, Bancor, Ren, the exchange token, Zcash, Synthetics Network, AVE, Chainlink, Verge, Cosmos, Zilliqa. So, and we can see obviously that the biggest one is Synthetic, Zcash, DX token, Ren, and Bancor. So, congratulations if you have made money. Ren has done fantastic. Look at that. As is Bancor. Over 20%. So, congratulations. Biggest losers: Compound, Digibyte, Augur, IOS, Siacoin, Decentraland, Celsius, Quant, and Wax. And of course, if we look at it, probably the biggest loser is Compound. But, Compound has been pumping like crazy. It has reached well over 300. It was time for that puppy to come down. And of course, that is exactly what happens. You will see that right over here, it was well over $333, and then it sort of came down. And that, of course, makes sense because, as I always say, whatever goes up has to come down and catch up with what's been going on to sort of close the gap. And, of course, same thing happens is when we have a severe drop, it kind of has to go back up to catch up to what's going on. And, the interesting part when we're dealing with our emotions, so to say, has to do with our behavior and our beliefs. When things go up, we all get super excited, super bullish. We jump in and we think that puppy is going to ride all the way to the moon. It never happens, right? It never happens. Same thing happens when things start tumbling down and we get into the panic mode and fear mode, and we think that the world is ending, and we think it's going to go forever, so we start dumping, 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 and then it doesn't really go all the way, through the earth into the core. It stops at some point and it comes back up. And that's one of the pieces that I think it's important for us to remember. For me, for you, for everybody to keep in mind, to remember that, you know, things do go up and down. Things are cyclical, and sometimes things will jump 20%, and sometimes they will dump 20%. And, you have to be prepared. If you're going to be in a market, you have to be prepared for those things. And of course, if you decide to leverage, which should be for professionals and experienced traders only, in my humble opinion, not a financial advice, just my opinion, then you can experience much higher gains and losses. And that's the reason why leveraging some of the trades in these markets can be very, very dangerous. And I think people that were going in and attempting to do the whole farming with the compound are learning that rather quickly, because while it was fun, while it was going, at some point when it stops, it no longer is fun, because then you lose money. So now, since we're talking about losing money, gaining money, let's talk about this article that I promised we're going to discuss, and that is, how do you dig yourself out of debt? Look, fact of the matter is that vast majority of us have debt. There's a lot of people that have a lot of debt. And, this article was very interesting to kind of look into, and very, very long. And we are not going to read the whole thing, but I'm going to cover this and use it sort of as a moment of education for you, for everybody in the world. These are the concepts that can be applied in personal as well as your small business. So I think it's very important. Well, large businesses can also do many of these things, and of course, they do it. Countries actually end up doing it as well. So it's not a secret about that. So they're basically saying that there are 4 different ways to get yourself out of debt. And we're going to cover those ways over here. So we're going to briefly cover them here, and then we're going to talk a little bit more in detail about each. So the first one is to basically say, let's build a realistic budget that helps pay off the bills on a consistent and effective basis. The second is you can work with the credit counseling company to help you out, and they can help you with when you have a lot of unsecured debt, like credit card debt. A debt settlement company is another way, a bit riskier sort of way, and a bit not for the weak of the stomach kind of way. And they help you through process of negotiating down the total debt. And we'll talk about what that looks like. And then final process is bankruptcy. So now we're going to talk about what does each one of these things look like. And this was an interesting piece, which is why I still kind of have this on, is that, fortunately or unfortunately, it just depends on how you look at it. There's a lot of shame when it comes to debt. There's a lot of shame when we don't do well financially. We all expect that we're going to go to school, get a good job, buy a good house, get married well, have 2.5 kids, a dog, and a picket fence, and that the life is going to be rainbows, butterflies, unicorns. And at some point, we realize that's not really what life is. Life is full of twists, turns, surprises. Sometimes those are really good and fun, and we really like them because something amazing happens, like meeting love of your life when you least expect it, right? But sometimes they are sad and nasty and painful, like losing a loved one, or, realizing that the person you love doesn't love you back, or, getting sick, or getting ourselves in debt. And, life happens. It happens for a reason. And I think there are lessons in everything that happens in life. We just have to be smart enough and in tune enough to listen and watch for those and reflect on those. And yeah, sometimes we react to them, of course. It's a normal, natural process. But I think at some point we have stopped we have got to stop reacting and start really reflecting on what did happen and why did it happen, and could I learn from this? What is the good thing from this? What is the bad thing from this? What did I do to make this worse or make it better? How can I benefit from it in the future, and how can I improve? And there's a lot more questions on reflection, and I highly encourage you to do that, to take a journal and to write things down, to be able to learn from it, because that is the way that we transform, that is the way that we grow, that is the way that we can do better. And I have found in my own personal life that when we don't learn from previous mistakes, we tend to repeat them, even if they're incredibly painful. And of course, you can't force somebody to love you, right? Of course, you can't prevent life from going away and losing a loved one. Those are some of the things that we can't control. I can't control the weather either, right? I have to go along with it. So there are certain things that you have to find strength to accept as they happen, right? And to embrace them as they happen. You don't have to love them, but you have to accept them. And then there are things that we definitely can control. And as they say in that famous prayer, you have to have wisdom to know the difference. Now, when it comes to debts, here is the wisdom. We do have an ability to make change, and this is hopefully the part for making that difference of how do we do this. And, shame, it happens, right? But don't let shame shut you down. Acknowledge it, deal with it, and then get into the action. The Americans, as they say in this article right here, you can read along with me. Americans owe a whopping $712 billion on their credit cards, according to the analyst of Federal Reserve and government data by NerdWallet. This breaks down to $15,355 per average household that carries a credit card debt, and the average household is paying $6,658 in interest a year, which eats up 9% of the average household income. So that's one of the things that I wanted to share with you because it puts it in a perspective, right? And the part of the problem is that we are not taught about money in schools, and perhaps that is the reason why you're watching and following Money Matters channel. And at this moment, I do want to welcome everybody who is watching that. And if you're watching on YouTube, do me a huge favor, hit that thumb up, hit the subscribe button, hit the bell button so you get notified. And the bell obviously notifies you to subscribe, just get you onto the channel so you can keep watching these shows, because we're doing them every morning at 7 a.m. only on onedealaway.com. And then you can, of course, join us live. I highly encourage you to do that, because we can come in, we can chat, we can interact on One Deal Away. When I finish this, I go into Q&A and we hang out. So it's quite lovely. I enjoy it. Hopefully you will like it as well. And of course, it's free to join. It's free to watch. But I understand not everybody's here at 7 a.m. Not everybody's up, and not everybody is in the same time zone wherever you are. This could be like, I don't know, 3 o'clock in the morning, right? So we got to acknowledge those pieces as well. But if you're watching on YouTube, do me a favor and hit the thumbs up. It does help with the algorithms. I've been told. I'm not a techie, so I don't know. And if I'm wrong, please let me know in the chat and let me know in the comments. And, do let me know how you think I'm doing. What are the things that you have? And if you have special requests, hit me up. I do read these. I do respond. I might not respond like right away. It typically takes me a day, maybe two, but I do respond and I do look at them. So there you go, putting it over there. So experts expect what I was saying before we go into the experts, what I was saying is that, schools don't teach us about money. So we don't know necessarily about personal finance and how to do that stuff. And even an MBA won't teach you that stuff. It focuses mostly on getting a job and the career. So we don't know what we're doing. And then now we have another problem, which is a problem right over here. Experts expect household debt to grow as credit card companies continue to loosen their standards and people are charging again, right? If you have money, we have to spend it. We have to live, food, water, electric, gas, right? Like heating and that kind of stuff, transportation, housing, clothes. There's all kinds of things, and everything costs money, which is why, for me, financial education is at the core of modern society, of ability to be able to not just survive, but definitely survive, but also potentially even thrive in today's economy, environment, society. Now, here's part of the big problem. And the big problem is that people are charging but not necessarily splurging. Adjusted for inflation, wages have stayed largely flat in recent years as the cost of healthcare has continued to climb. And not just healthcare, right? I would say rents, food, gas, cleaning supplies, school and education, that has gone through the roof. So just about everything we have to have has gone through the roof, right? And to stay above the water, many would have to decrease their spending. The problem with that is that sometimes that's not as easy. So what do? Sometimes we try to get another job. Sometimes that works, sometimes it doesn't, right? We try to use credit cards to close the gap. And if we can't pay that, emergencies come up. A washing machine breaks, a roof blows away, window gets broken, car gets damaged, kid gets hurt. All of those things cost money. And so what are you going to do if you have a kid that broke a leg? Are you going to be like, well, hobble because we can't afford to pay for the medical? No, of course not. You take that kid to the emergency room. You get that foot fixed. You pay for the x-rays and the pain meds and all the visits and the therapies and everything else. But all of that costs money. So we are forced to be able to go in and charge that to the credit card. Then we end up racking up all of these bills only to find ourselves in a position where we look at one point and realize, my gosh, I owe all this money. This can be a very overwhelming situation. I get it. I lived through it, and I don't want to do that kind of life again because it's very stressful. And, you lose sleep, you start sweating profusely, your skin is kind of crawling every time you think about it. You don't feel well, you get sick to your stomach. Perhaps you get angry and take your anger out at the loved ones. So we behave in very, very weird ways. And all of it has to do because we are stressed about our finances. So if this is the case for you, let's talk about some of the things of what you can do and, of what you can do to help eradicate this stuff. So here we go. Here's the first thing that they say. Make a budget and cut spending. Take a look at what is your income. Well, number one problem that many people have is we don't know. We know where our money comes from because most of us have like one, maybe two jobs. And so we know where our income comes from. Most of us don't know where that money goes when it hits us, right? It comes into your account, it goes somewhere, we have no clue. So the best thing to do is to start tracking where do we spend money. Of course, you can do that with a pen and paper, or you can use some online tools and apps. Most of them are free. And, Mint, for example, is one of those that you can use to track where your money goes. Now, this gives a big eye-opening experience to understand. Then you can take a look and say, yeah, it's nice to have some of these things, but do I have to have them? And right now, I am on a mission. It is my goal to, let me lower the shades, y'all. Hold on, please. My apologies. The sun was starting to come out, and I'm like getting washed out by the sun. I can't think straight. What you want to do is you want to basically make this a mission to say, reducing the debt is more important to me than receiving this magazine or having a subscription to Netflix or whatever it is that you have. Then you have an ability to cut some of those things and apply the difference towards the credit cards. Now, there are different ways that you can actually pay off your debts. One of the ways to do that is to pay off the debt that has the highest interest on it. So if I have three credit cards, for example, I have one that has 5% interest, which I don't know how many people have that. I don't even know if that exists. Then you have 12%, and then you have 20%. The math-based process towards it says pay off the 20% first. Okay. There's a second base, and that is pay the lowest balance first. That is human-friendly version of it. And it says if I have three balances, regardless of the interest rate, one is 1,000, one is 5,000, one is 10,000, pay off the 1,000 because it's much faster to pay it off. You gain a momentum. you feel good and you want to keep going. Now, different people behave different ways. Some of us are much more analytical and we go with the highest interest. Go for it. Some of us are much more emotional and we feel like when we check off a box, we feel like we've accomplished something. And so we should go with the lowest amount first and then roll those things into a snowball to pay the rest of them. Whichever process you take, it is perfectly fine. Just take one, stick with it, make sure you track it along the ways, and make sure that you actually go in and take care of the bills, right? You know, take care of the minimum and then put as much as possible towards either your lowest amount or the highest interest, whichever option you decided to take. Once you pay that off, whatever you were paying towards that, you roll it over to the next account and then you pay that off and then you keep on going until you pay all of it off. That works if you can actually afford those pieces and if you can actually, right, like if you have enough income to cover for all of those things, and but you're gonna have to cut some of the stuff. I'm sorry, I know it sounds horrible, but if you really want to get out of debt and your income is not meeting the needs, you're gonna have to make some cuts. It's gonna be painful short term, I understand. Long term, it might have a lot of benefits. Now, if you have a bit more and this seems very unsustainable to you and you need additional help, here is another way. Nonprofit credit counseling. Nonprofit credit counseling firms work out a payment plan for strapped consumers negotiating with creditors on their behalf. So what they will do is they will reach out to all of the companies where you owe money. You will be asked to cut up your credit cards, and they will come up with one payment that you pay to the nonprofit, and then the nonprofit negotiates the rates and the payments and stuff, and then they pay off all of the other companies. Sometimes they do this for free and just ask for a donation. Sometimes there's a small fee of kind of how to help you with the payments, and so you know they are very good in being able to help you out. And you know, of course, you're going to have to operate on a cash basis for a while, but you know your credit might be dinged for a bit, but it's okay if you're trying to get yourself out of that. The moment you kind of settle that, it recovers relatively speaking quickly, so I wouldn't worry too much about it. Inability to sort of reduce that, it does eliminate this huge emotional uh, bag that you have to carry on, right? And it feels makes you feel freer. You can breathe better, sleep better, eat better, and you can recover so much better financially. The third step is a bit riskier step, and it is probably for those that are much deeper in debt and struggling much harder. It's called debt settlement process. Let's take a look. That settlement process, basically for-profit firms operations that offer to help consumers settle their debts for less what they owe. Their process is essentially a high-stakes game of chicken. Debt settlement programs generally require consumers to stop paying their bills and allow their debt to go into delinquency and then eventually default. So instead of what we were doing with the nonprofits, where you're making payments and they kind of settle and make payments and stuff, that settlement company says stop paying everything. Whatever money you were going to pay, you need to start putting into some sort of escrow account. If they coach you well, that's what should be happening. You put it in the escrow account and you keep accumulating it there, letting your debt basically go to the wayside. Now, you might start receiving phone calls from creditors constantly calling, trying to collect, trying to collect, trying to collect, trying to collect. You're going to have to live with that stuff. And then the debt settlement company is going to call all of them and attempt to negotiate basically down, not just interest rates down. So like if you're at 20%, they negotiate it down to like 8% so that you can pay it off faster. It's, excuse me, coffee time. It's more like they're going to negotiate in such a way where they're going to take the $10,000 debt and try to negotiate down to $1,000. But they can only do that if you're not paying anything. And so the part of the process and part of the problem is that the company, the person or the company where you owe money doesn't have to settle. They can, but they don't have to. So it really ends up being the sort of game of chicken that oftentimes they will, but not always. And you have to be emotionally, mentally, and physically prepared that they might not necessarily decide to settle. And it's going to get super ugly before it gets any better. Okay. So that's something to do. If you decide to go with the debt settlement company, make sure you find a reputable company. Same thing for the nonprofit. Find reputable reputable companies. Do plenty of research before you decide what your next steps are going to be and going with a company. And then get emotionally prepared that it might actually get really, really bad, because those phone calls will start and they will not stop until things are being settled. The final and fourth way to do this is bankruptcy. Bankruptcy is the end of the line when it comes to debt elimination. The best thing to do is to reach out and consult with an attorney to find out what the process is. Now, most of them will actually do counseling for free, right? Like that initial consultation piece, just to explain the process. However, going through the bankruptcy process is not free. It will cost money, and you need to be prepared to do that. There's additional pieces that you should know, and let's read together about it. So, two different types of personal bankruptcy, Chapter 13 and Chapter 7. Chapter 13 allows those with regular income to repay debts over 3 to 5 years. So that basically allows people who are behind on mortgage to keep the house, catch up on payments over time, and pay off all the other stuff. Chapter 7 wipes out all eligible debt, credit card balances, and so on. However, those without regular income must file Chapter 7, which typically takes about 3 months to complete. Filing for both kinds of bankruptcy stops collecting the collection calls, right? So that's the sort of the nice part about it. However, there are, it has to go to the court, and it can stay on the credit report for up to 10 years. And it's sort of like this black mark that exists for 10 years, but it does expire after 10 years. And it will follow you for 10 years if you're looking to buy a house, get any more, credit in the future, rent a place, get a job. So there are definitely consequences for it, and it should not be taken lightly. Your credit score will recover relatively quickly, often within a few years, so much faster than this black mark. But of course, when they pull your credit, it's not just your credit score. They're going to be able to see a bankruptcy, and so you might be prevented from doing stuff. So process itself can cost thousands of dollars in attorney's fees and hundreds of dollars in court filing fees. Lawyers generally ask for payment upfront in Chapter 7, whereas in Chapter 13, attorney fees are built into the payment plan. So the biggest piece to know is that you do have options, okay? So that's the biggest piece that I want to leave you with. And one of the things that we do offer at One Deal Away, we do offer many different courses within the academy for super low payment. And one of those things is how to eliminate your debt. We talk about the credit card debt, student loans, explain how it all works. And, if you're interested, it lives within that piece. But I think you have plenty of information right now to get going with the process if that elimination is what you're looking to do. I wish you best of luck. Stay with it, stick with it, and do explore all of the options and then choose the one that makes the most sense for you. Become educated first and then take action. As I always say, right? Taking action without education is stupid. Having knowledge without action is useless. You don't want to be stupid. You don't want to be useless. You want to combine both. So you want to learn first, then take action. Now, we're going to change our topics right now and shift into the larger economy of what's going on with the Fed, because we talked about how do you protect yourself and your money, right? But now, how do we benefit from what's happening inside the Fed, inside central banks, and how do we, where are we going and what's going on, and how do we set ourselves up really well for where we are going? So, coffee, and then let's do this. That was lovely. Okay, so let's take a look at the stock market. So this was a fabulous, fabulous, fabulous article that basically said, let's take a look at the stock market, but let's remove the giant five, right? The Apple, Microsoft, Amazon, Google, and Facebook. Now, it's interesting that in this giant five, they're using Microsoft, but most of the other ones, you know what they use? Use Netflix, right? So it's very interesting, slightly different. And I don't know if they did it to make the numbers work, so I don't know. I haven't talked to the guy. But it is an interesting piece nonetheless. So they're basically saying that the market capitalization rate of the five largest stocks combined, Apple, Microsoft, Amazon, Alphabet, and Facebook, Alphabet is Google, right? So you know that, rose to a new record of 6.18 trillion since a low on March 16, and their market capitalization has soared by 51%, or an increase of 2.1 trillion in, let's say, 3 months, right? So look at this. Very interesting, isn't it? Now, overall stock market capitalization, as measured by Wilshire 5000, which is the whole of the stock market, ticked up to 31.8 trillion, up by 41.6% from its low in March. Now, the giant five accounted for nearly 20% of the total U.S. stock market. On January 3rd, 2017, giant five had accounted for 10%. Since the crash in March, the giant five have soared from about 16 to just short of 20%. It's very interesting that in 3 years, we have actually gone, and you can take a look at the chart. It's very interesting that we have gone from 10% in 2017 to 20%. So we doubled in 3 years? Interesting, huh? Now, take the five largest stocks out, and what's left over is now valued at 25.7 trillion. It's up by 28.4% from the March of the low in March, but far cry from 51% for the giant five. All these companies combined, minus the giant five, are way below their peak in February of 2020. The entire rest of the stock market and all its winners and losers combined, minus the giant five, since January 2018, was basically a very rough and unpleasant ride that basically led to negative 1%. And you can kind of see what happened. So this is the entire stock market. You take out the giant five, and you can see kind of has been going up and down. It actually spent a lot of the time down. Look at this, y'all. And then, we basically are ending, not much has happened. So very interesting piece, right? Very interesting piece to kind of note. Now, this is how dependent the stock market is and have become on the giant five. Apple, Microsoft, both are now worth over $1.5 trillion. Amazon is at nearly 1.4 trillion, and Alphabet is at 1 trillion. Now, these are gigantic valuations, and what they're arguing in the article over here is that we've seen some of this in the past, where you had the giant companies, and interesting piece is, where are they now? So, they go in and say, well, we did have one of those, and it's ExxonMobil, which since January of 2018 has lost 48% of its value. So that's one of the things to keep in mind, and it's sort of like a warning signal to say, this is great. The market is going up because these puppies are going up. But if they sell off, the impact of these five companies is going to be proportional to their giant size, meaning 20% of the market is in these five companies. And if something was to happen to them, we can expect big problems for the entire market, and of course for pension funds and mutual funds and funds and all kinds of stuff, right? So that's an interesting piece to keep in mind. And I think you need to understand the risks before you go into any of these things. Now, we've been talking about, and we've been hearing a lot about folks talking. Sorry, I keep moving the camera. My apologies. I'm fidgety these days, as you can see. I don't know why. Um, but the interesting piece that I do want to talk about, and that this particular article is going to address, and then we're going to go into the chat and the Q&A. But before we do that, interesting piece to note is that we've been talking a lot about Fed printing money, Fed buying assets, Fed going into ETFs, buying all kinds of stuff. And I have just seen some articles that are basically saying that, wait a minute, there's a giant shift in what the Fed is doing. And I actually have an article that is very interesting that says, it looks like folks are starting to shed of what they're doing, and Fed is shifting in their behavior. Here it is. Now, Fed has been cutting back for weeks on its asset purchases. Now, Bank of England Governor Bailey published massive central bank balance sheet mustn't become a permanent feature, and this is a piece in Bloomberg Opinion. Now, as economies recover, it's likely that some of the exceptional monetary stimulus would need to be withdrawn. This is the opposite of what they did the last time, and they're basically saying what we're going to do is before what they did is they would go in and they accumulated all of these things. They bought up all of these things, and then they increased their rates, and then they started shedding the balance sheet. What they're doing now, and what the Bank of England is talking about doing now, and inviting all of the other central banks to do the same thing, is to reduce the balance sheet first before they increase the rates. This is very, very, very different than what they were doing before. Central banks have made big decisions and implemented them rapidly. This capacity to act must be reinforced and must not mistakenly be called into question. But the financial system must not become reliant on these extraordinary levels of reserves. So it's almost like the Bank of England is saying, don't question what we do, which I don't know if we should or not. I think it's important to understand what they're doing, and it's important for them to share what they're doing and why. Uh, but what they're saying is don't question, let us do our thing, and don't rely on us. You shouldn't be relying that we're going to be keep on buying stuff and then we can keep on doing things. And it's, to me personally, when I read this, it's basically a warning to say, if you think we're going to be propping things for forever, we're not. At least Bank of England is saying that. Now, let's see. The Fed excessive reserves had surged during the QE1, QE2, QE3. Then they began to unwind through mid-2019. Now, during the repo market, bailout starting in mid-September 2019, right? So as soon as they started to unwind some of the asset stuff, the repo market started to crash. So they actually had to go in and step into the repo market in mid-September 2019, and the reserves started to rise again. When the repo market bailout began in January 2020, reserves ended in January 2020, reserves flattened. In mid-March, Fed unleashed the money printer's fury, and reserves skyrocketed. And you can actually see that in this chart right here. And while you look at that, I'm going to have a bit more coffee. Okay, so that's an interesting piece, right? So it's important to understand that when they print, the balance sheet goes up. When they start cutting, the balance sheet goes down. And that's basically what they're sharing over here. Now, they're saying, continuing on, as economies recover, it is likely that some of the exceptional monetary stimulus will need to be withdrawn. Remember, he's basically saying, we're thinking we might need to do this stuff. Central bank balance sheet need to be trimmed down because elevated sheets could limit the room for maneuver in future emergencies. So this is one of those interesting pieces because I think they're learning from what's going on. And remember, we started the whole episode and conversation about the ability and the need to learn from your previous mistakes. And part of that piece is looking at what worked well, what didn't work well, and how do we improve on that stuff, right? Like, how do we make it better? So what we want to do is to make sure that we look at our personal stuff, and we already talked about it, but central banks are looking at their things as well, and they're saying, wait a minute, when it came out, we were really strapped and this was really scary. So it looks like they're going to basically start reducing their balance sheet sooner rather than later. That's at least what I'm reading. That's not what they're saying here, right? That's at least what I'm reading, because what I am seeing over here when I read this stuff is that they're saying, you know, if something was to happen again, and it could, because the virus is not gone, it's coming back. We're expecting a second wave to come back. And if we need to do this again, we need to shut down again. We need to, bail out everybody again and do it even bigger and faster. Currently, we're not able to do it. So we need to basically cut our balance sheet, reduce the balance sheet, and then look to increase our rates. The interesting piece is the Bank of England is basically not mentioning anything about negative rates, which sounds like it's off the table for them. Fed has gone in and said interest rates are not even an option. We're not even going to discuss that. That's not what we're going to talk about. Now, again, we'll see. We'll see what happens in the future, whether the economy recovers, how fast, whether the virus continues to pick up or not, whether people get employment or not. There's so many different things that still have to be taken care of and covered. But the interesting piece is that, as you've seen from this particular article, is that the Fed is indeed cutting what they're buying. And there's another article that I'm briefly going to mention, and then we're going to finish this here, is that the Fed is ending the QE, total assets drop, and liquidity injection ends. And right here, you can see that there is weekly change in total assets in billions. Now, most people are not talking about this stuff, and I don't have a TV. I don't watch TV. I don't have a cable. So I don't know what people are exactly saying on the mainstream media. But it wouldn't surprise me that the rhetoric is that they're buying stuff, and they have been. Of course, they did do that in March and April. But as you will see right here, is that the total assets is actually dropping down, and they are definitely unwinding their balance sheet. Now, you will also see that the total asset in the Fed balance sheet, this is sort of pre-March crisis right here where my mouse is. I'm kind of moving it erratically so you can see it easily. And you can see kind of it's gone up, sort of slowed down, but you can see how the curve is flattening, similar to something else that we've seen. Can you remember? The stock market. Folks, the stock market. And this is why in today's episode I was saying, could the stock market be crashing again? Now, the interesting piece that is going to happen is that we're seeing the Fed is basically going in and saying, we got to put the pause on this stuff. Now, they're creating these special purpose vehicles, which is basically an LLC that goes in, and you can see that repos have also gone down. So they're cutting. They're cutting on everything. Liquidity swap being cut. And we're going to talk about SPVs in a moment. I didn't forget. But I want to make sure that you can take a look at this stuff. Now, the liquidity swap basically means is the Fed gives the dollars, takes their local currency, and then at some point that particular country or central bank pays back the dollars, and the U.S. pays back its local currency. So that's what basically the swaps are. It's just basically lending between the currencies. Now, the Fed doesn't want to buy junk bonds, ETFs anymore. So they are basically declining. The SPVs are declining by incredible amounts. So this is the part where we're going to talk about SPVs, and I'm going to let you take a look at the charts. So the SPV is special purpose vehicle. It's an LLC that the Fed creates, and anybody can create a special purpose vehicle that has a special purpose. And these special purpose vehicles were basically created to be able to buy certain things and bail out certain things. And as you can see right here in the chart, that these were kind of, pretty much going up. And yes, it has gone up, but the number of it and what's going on for each of the vehicles is actually going down. The two that grew are basically the tiny amounts is the corporate credit facility, which is the yellow. So you can see the yellow one. And the Paycheck Protection Program Liquidity Facility, which is the red. So you can see that the red has grown a little bit, which is the buys government guaranteed forgivable PPP loans from banks. All others SPVs declined this week, and the new kid on the block in this week is the revived and reviled TALF, which is not yet part of the chart because it has a small negative balance, sign that it's not fully operational just yet. Now, what is TALF? Well, let's look it up. So I decided, let's look it up together. So I did. I looked it up. Thank you, Internet. So then you can see that TLF is a credit facility authorized to help meet the credit needs of consumers and businesses by facilitating the issuance of asset-backed securities and improving the market condition for ABS more generally. Okay, so they're saying, yeah, that sort of started, but not really. It didn't move much of anything, so we don't expect much of that stuff. Now, there are now 3 SPVs that route funds into the consumption rather than asset purchases. This is a big shift, y'all. This is a very big shift. The Paycheck Protection Program, the Main Street lending, and the municipal liquidity. This is not QE per se, but more like paying businesses and municipalities to ultimately workers' consumptions to consume. So this is the money that is meant to go out in circulation, not necessarily prop the asset prices. Now, this is a big change because if we're talking about this particular piece, is that so far up until a couple of weeks ago maybe, most of the programs were going to prop up the asset prices. They're shifting their methodology, perhaps because they too are seeing that market is severely uncoupled from economy, and we need consumption to catch up the economy to the market. Now, they don't want to necessarily crash the market. I think they want to catch up the economy and consumers to the market. So, and the economy can only be caught up by consuming. So now they're trying to put in money towards the consuming, and I think they're going to be looking for ways to improve and reverse the trajectory of the money velocity. Money velocity is basically how quickly we can actually trade that money. How quickly does it trade hands? Does it come to me and then I pay you and then you go do something else and that person that you did something with does something else? And so that's the money velocity. How quickly can that change? And what we've noticed is that it's been dropping severely, and this panic, this crisis hasn't helped it. It actually has been lowering it. So, but if all of this money printing goes into consumers and they're able to reduce or increase the velocity of money, or to reduce the velocity of the money is falling, so increase the velocity of the money, we could at that point start getting out of the deflationary piece, depressionary piece, but we might hit inflation on the other end, and it might be higher than 2% that the Fed wants to hit. That's their target, okay? So something to pay attention and watch out for. Fed added 26 billion Treasury securities during the week, bringing the total of 4.17 trillion. Over the past 4 weeks, the balance increased in a range between 9 billion and 26 billion, about the same range before the outbreak of bailout mania. And you can see kind of where we were. So in January, right, like we've been always sort of flirting between 0 and say 50 billion per week. It's kind of been going up and down. And then we did this crazy thing in March and April. And as you can see, it definitely has fallen, and we're right back within that range. It's a bit more volatile than prior to March. I will agree to that. But we can all agree that it is actually going down. So this is definitely interesting piece. And they're saying that, they are looking to, it's the same thing. Securities, Fed balance sheet. Again, same thing, guys. And gals for that matter, so not trying to be offensive at all. It's tapering off, and to me that really signals that we could potentially be hitting into a very potentially problematic components within the markets, and that is the fact that market could potentially over the next short term go down, and go down relatively quickly. So because if they're not buying and the big investors are not buying, unless the Robinhood app users continue to do crazy things. But I'm also going to make an argument that most of them probably don't have as much money as the Fed or the large investors. So even though we might be seeing another big dump coming in the near future. Not an investment advice, just my thoughts and opinion based off of what we just saw and talked about. Now, of course, you want to do your own due diligence. If you decide to play the markets, you want to pay attention to things. If you're trading, you want to know what you're doing. Pay attention to leverage if you're using any. I don't recommend using leverage unless you are an expert and know what you're doing. And I do believe in investing as opposed to trading. That's just all of that. None of that is financial advice. All of that is just my personal ways of how I view money and life around money. And the final piece is, have those protective stops, y'all, so that you get stopped out of the market. But do understand they don't work 100%. Because if the market opens, say that I have a protective stop at $10 a share, right? And right now is at 15. So I'm like, yeah, if it goes down $5, like I'm fine. I'll live, whatever, right? I'm making up the numbers here just to bring the point. That's all fine and dandy. If the market is behaving normally, it will come, hit the 10, sell, and then, if it goes lower, I basically get stopped out. I get sold out of the market. I don't lose more. There's a problem that sometimes it drops so severely and liquidity is gone that it cannot sell at 10. It will sell at 8 or 5. Or what sometimes happens is that the market, remember, it has the open and the close, and there's stuff that happens after hours or before hours, however you want to take a look at it, which is the futures. And what can happen is that it could close on $11 today. Tomorrow morning, when it opens at $2. So even though I have the $10 protective stop piece, if it opens at 2, it's going to sell me right at $2. But the problem is I didn't lose $5, right? I lost way more than that. I lost $13 per share, right? In this particular example. So just something to pay attention to. It's not perfect science. It doesn't work 100%. So if you experience a very big crash and there's no buyers, that stop loss order might not be fulfilled. And it will be fulfilled at some point, but it might not be anywhere close to what you were hoping to get. So just something to know about in case you're counting on that to be 100% piece that gets you out. So there you go. Hopefully this is helpful to you. If you have enjoyed this show, do me a favor, hit the thumbs up, do subscribe, and do join me tomorrow at onedealaway.com/live where we can hang out. Thanks for watching. Until next time, stay forever money blessed. And do remember, you are only one deal away.